Hello students, welcome to my class. This is Professor Vincent Usaya. This is part 4 of chapter 8 presentation. Chapter 8 receivables. This is where we left off on part 3. Here we are going to demonstrate how to use the aging of receivable method to make adjustment for bad debt expense. In the previous session, we indicated that we have two methods for making provision or for accounting for bad debt expense. Number one method is the direct write-off method, and number two method is the allowance method. And we said that we have three types of allowance method. Number one, we said that percent of sales. Number two, percent of receivables. And number three, aging of receivables. These three methods are different examples of the allowance method. So we talked about the overview of this method, and we said that the first one is very straightforward. Percent of receivable and aging of receivables are very similar because you have to take into consideration the balance of the allowance for bad debt. So we talked about that in the previous session, and now we are going to take a look at how the aging of receivable is being implemented. So let's take a look at what happened here. As you can see here, all the receivables are put in different ages, okay? So we have receivables that are 1 to 30 days due, 31 to 60 days due, 61 to 90, so on and so forth. Now, by the time we map out the receivables in terms of different ages, we wind up having total for each group. Then we come up with an estimate of the percentage that might not be collected based on each group. Conventional wisdom says that the older an account, the more likely that we are not going to be able to collect. So we assign a higher percentage to those accounts that are very old versus those accounts that are only 1 to 30 days past due. So as you can see here, for the accounts that are 1 to 30 days past due, we have 1%. In contrast to accounts that are over 90 days, we have 90%. So we do the math, and we come up with 42, 17, so on and so forth. When we add up the total estimated uncollectible, we come up with $185. Now, I want you to make a note of something. This is very important. This $185 is what we mean by the target balance using the aging of receivable method. Remember, we talked about that in previous session. We call it the target balance, or we call it the desired balance of the allowance for bad debt. Remember, the allowance for bad debt account is the contra account to accounts receivable. So let's take a look at how this works. Take a look at the example that they have here. The allowance for bad debt before we did our aging has a balance of actually, they skip a step here in this example. This might confuse some of you. Let's go ahead and work this out and take a look at what is happening here. This is the allowance for bad debt. At the beginning of the accounting period, we had $80 credit. Then, during the period, we wrote off $25. So the $25 that we wrote off of the customer reduced the allowance for bad debt. Now, at this point, the balance, or the desired balance rather, based on what we calculated of the allowance for bad debt, is $185. But in the meantime, the question is, what is the amount that we need for the adjustment that we are talking about? Now, if our desired credit balance is $180 and we have 80, 25, then we need 130 here to have $185 balance. How so? Because take a look at this. If you add this up, you have 210. minus 25, you have $185. So the desired balance, like we said, is $185. So that is how we figured out the credit or the amount that we use for the adjustment. So we make a journal entry by debiting bad debt expense for 130, and we credit the allowance for bad debt for 130 as well. So moving forward, alternatively, take a look at what the slide said here. The unadjusted credit balance, I skip this step. The unadjusted credit balance here is 55. So we have 80, we have 25. The difference between 80 and 25, this is the step that is skipped, is 55. All right? So we have a credit balance of 55 in the allowance for bad debt. Now, by the time we put the receivables into different ages, our target balance is 185. So our desired balance is 185, but we already have $55 credit. In order to get 185 from 55, that will give you 130. So our target balance is 185, and we need 130 adjustment to get to 185. In other words, we need 185, but we have 55. The difference of 130 is the desired balance. So we debit bad debt expense for 130, and we credit allowance for bad debt for 130. So let's take a look at objective 4. Here we are talking about how to account for notes receivable. We talked about the notes receivable previously. We said the customer gave us a note promising to pay us in the future instead of oral promise. So how do we record that? So we talked about the overview. Here's an example of promissory note. You can go through all the parts yourself. We have the principal, we have the interest, the payee, and the maker of the note, so on and so forth. So here's an example. On September 30, Smart Touch Learning loaned $1,000 to Lauren Holland for 1 year at 6%. So I want you to know here that we are zeroing in on the records of the lender. All right. So this is the books and records of the lender. So we are going to debit notes receivable. That is the notes receivable that we receive from the borrower, and we credit cash because we are extending credit or we are extending loan of $1,000 to this company for 1 year at 6%. So let's take a look at what happened here. How do we record interest? As you know, the formula for recording interest is principal multiplied by interest rate multiplied by time. Again, time is always a fraction of a year. So if we are talking about less than a year, we need to take the fraction into consideration, or the fraction of the year. So let's take a look at what happens here. On December 31st, that is 3 months after the loan was extended. The loan was extended on September 30th. So October, November, December, that is 3 months. At the end of December, the note is not due yet because it's a 1 year note. But at the end of December, we need to make provision for 3 months of interest that we have earned but we have not received, in order to be in line with the matching principle, which says that we have to recognize all the expenses with their related revenues. So we do the math. Take a look at how we compute the interest. 1,000 multiplied by 6% multiplied by 312, because we are zeroing in on only 3 months interest. When we come up with that, we have $15. So interest receivable is $15. We debit interest receivable for $15, and we credit the interest revenue for $15. Now, here sometimes a customer would dishonor a note. What does that mean? The customer did not pay when the note was due. So what do we do in such circumstance? In such circumstance, we have to recognize the interest and the note as accounts receivable, and get rid of the note by crediting the note. So you can try this on your own. And the last objective is objective 5. Like I told you at the beginning of this presentation in part 1, our objective here is to learn accounting principles or accounting rules relative to receivables, how to apply those rules, and in order for us to prepare balance sheet completely accurately in line with the accounting principles, then eventually communicate the information to internal and external users of the financial statement or the information. And lastly, we analyze the underlying information. What do the numbers really mean? We do the analysis, and one of the techniques for doing the analysis is ratios. Okay, so here is a very popular ratio. It's called asset test ratio. Asset test ratio measures a company's ability to pay current liabilities or current obligations. So it is computed as cash plus short-term investment plus net current receivable. As you can see here, accounts receivable is not part of the numerator because it takes a while to collect accounts receivable. So here we are measuring the company's ability to pay short-term debt as quickly as possible. So we talked about current ratio in another previous chapter, but here we are zeroing in on asset test ratio or quick ratio. Again, like I said, measuring the company's ability to pay current liabilities as quickly as possible. So we divide the numerator by total current liabilities, and that will give us the acid test ratio. We call it acid because of the chemical acid. If you put it on an element, it burns it right away. So in this case, look at what we have here. We have 70.74 or 74 cents. What does that mean? That means for every $1 that we have in current liabilities, we have 74 cents to pay it off as quickly as possible. That is not as good as 1-to-1 or 2-to-1. That is the conclusion of chapter 8.